Welcome to Real Estate Radio Live, an informative and engaging hour discussing everything you need to know about the world of real estate. Your host, Tom K. Wilson, provides you with insight and guidance from his years of experience as a successful real estate entrepreneur on how to buy, sell, finance, and invest in real estate, and much, much more. Now, here's your host for Real Estate Radio Live, Tom K. Wilson.
Thanks for tuning in to our Real Estate Radio Live program today, your number one source for all of your real estate needs and education. We're broadcasting from the number one business radio station in the San Francisco Bay Area, KDOW AM 1220, the Wall Street Business Network. I'm Tom K. Wilson, your host for the 2 p.m. Wednesday edition of Real Estate Radio Live that comes to you daily, Monday through Friday at 3, along with the 2 and 2 o'clock edition on Wednesdays and Thursdays. If you can't make the live show, you can catch our podcast on reradiolive.com, and you can catch my programs on tomwilsonproperties.com or on iTunes or on YouTube. We encourage you to go on the website, tomwilsonproperties.com, and sign up for our weekly newsletter. Also, we have various white papers such as how to select the best metro and investment product to invest in and how to go about that. And we're always welcome your suggestions, questions, and we're available for consultation anytime that we can help you. In the studio with me today is a good friend and someone who's very well known here in the Bay Area, Michael Morrongiello, and he's been an active investor since, for 4 decades. He's the president of the Bay Area Wealth Builders RIA up in the Marin County, and that's been going for a long time. Certainly one of the top 2 investment clubs in the Bay Area for a long, long time. Great content, great speakers, and he's very not only been investing in all kinds of real estate properties, but he's also a specialist in notes and has been doing that for a long time. And we have on the line with us today from Georgia, Dyches Boddiford, who is also a 4-decade investor, has a degree in physics from Georgia Tech and an MS in computer science. So he's yet another techie who's found real estate and loves that as a second career. Dyches is an investor for 4 decades, author, educator, written many books, taught many classes, asset protection, self-directed IRAs, mobile homes, discount notes and mortgages, private money, and much more. And it's great to have him. Dyches, welcome to the program.
Thank you very much, Tom. Glad to be here.
Nice to have you with us. So tell us your story about how you transitioned from being a techie to real estate.
Well, it has to do with, I'm sure, what a lot of your listeners go through, and that is that they initially thought they were going to climb the corporate ladder, and that was the way they were going to measure their success, only to come find out that after you get to a certain level, the people above you have to retire or get fired before you can move on up. So you start looking at something outside of regular work that you can start putting your money in investing. And real estate was most attractive because of the sweat equity part of it, because at the time, which was 1980, I didn't have a whole lot of money, but I sure had the weekends and afternoons that I could go work on property. And so that was really what got me into it to start.
You did a little bit of what, prior to Georgia Tech, you were did a little bit in the construction industry?
I have done some construction work and all, but not a tremendous amount.
Mm-hmm. Enough to get a little feel for it and not feel too uncomfortable about it.
Right, but I grew up on a farm, and if any of your listeners have ever had a family on a farm, farmers end up doing a little bit of everything: wiring, plumbing, building, putting up drywall, so forth. So I learned a lot of what I know about real estate, about the hard part of the real estate, from growing up in high school and working on properties around the farm.
I can relate. I grew up on a farm also, Dyches,
All right,
in Virginia. Another Southerner.
Yep.
Good. And so And so, what was the first thing you purchased or got in real estate? What was your start?
Well, I did what I was taught to do, and that was to ride around and look at a bunch of properties and make offers on properties, and only feel like you really need to buy something after you looked at 100 properties, which by that time you should have a real good feel for values. And I did not keep an accurate count of exactly how many properties I looked at, but it had to be close to 100, if not over 100. And I made 3 offers 3 days in a row, and I got all 3 offers accepted in 3 days in a row. And that was a big change because I'd been looking for months, driving around looking and making offers and none being accepted or countered at such higher prices that I didn't feel like it was a value. So I got these 3 houses all at one time, and I had to start splitting my time between the houses plus a full-time job. So one house was a VA house, which VA still sells and finances to investors. One house was owner carryback financing. And the third house, I got another investor to put up the money because it was so cheap. And I was able to pay them back in just about in 3.5 years, I believe it was, and still made a profit on that little house. So that was kind of how I got started, just different avenues, and it was good experience to have those different avenues.
Once the bug bites, especially if it's success in the beginning, right?
That's exactly right.
The main risk I find for a lot of folks, including myself, is if the first ones work good, then you kind of get overconfident and think everything you touch is going to turn to gold, and then you have a little surprise.
Well, it's funny that you should say that, Tom, because in 1985, I started getting a little bit big from my britches because everything was working, and I was doing some buying some notes and mortgages and more rental property. And I said, all these small deals, I need to do something bigger. So I decided to buy a 3-building apartment complex of 40-something units. And so I bought that with bank financing, and really when the smoke cleared, I had no money out of my pocket. And of course, we know what happened in '87 and '88 with the FDIC and the RTC and so forth. The banks called the loans because they were commercial loans. That's something listeners should understand. Is even if you're current on commercial loans, the lender still has the right to call it. And if you have the most equity or you're the one that's regularly paying, they figure that you can come up with the whole amount, which is not necessarily the case. Fortunately, I was able to negotiate and move things around, but I ended up literally losing $100,000 of cold hard cash in that deal.
And that was a lot of money then.
That back then, that was a tremendous amount of money. Fortunately, I started doing the single-family houses again and added to the single families I already had, and it went very well and moved on into other things. But the lesson was not to try to do one big deal. It's much better to make it big on smaller deals.
Distribute your risk. Huh?
Exactly.
Yeah,
it's just like if you're investing in the stock market. You don't put all your money in one stock. You do an allocation across the whole group of stocks.
Wilson Investment Properties sells investment houses to folks, and some of them are ones that are considering a multifam, but all the money they have to put in investment is just enough for one multifam. So, I tell them, geez, I like them, and there's room for it in your portfolio when you get big enough, but if it's too many eggs in one address, you got too much risk. Go distribute it in multiple houses or put it in various syndications of a commercial so you don't have too many eggs in any one address.
Good advice, Tom.
Yeah.
I wanted to just say
please.
one thing here, Michael here. You mentioned that you were, in baseball terms, 3 for 3 on your offers that you made on those houses. But obviously you laid a lot of the framework by looking at a lot of property before you made those offers.
Absolutely.
Don't want to mislead our listeners here to make it sound like it's that easy, but clearly you did do the homework up front before you got those before you was able to write those offers and get them accepted.
Might have been only batting average of 300 if it had been if you hadn't done all that homework.
Yeah, a lot of practice. I mean, even in true baseball terms, there's a lot of practice before they go out for the game.
Yep. I have a property I bought for $568K one time after looking basically for 5 years and being under 5 contracts. And that house went up in the peak to $4 million. And people think, well, my gosh, how lucky you were. They didn't realize I'd spent 5 years and went in 200 properties to find that needle in the haystack.
That's right. And I hear a lot of people that are not in the business talk about how lucky us investors have been. And we just put ourselves in the way of something that's about to happen. That's where the luck is. It's not because we just happen to be there. We put ourselves there. We put ourselves in the path of progress and the path of opportunity. And
once you get yourself sufficiently educated, then look for the doors, and when the door opens, be willing to take the risk to walk through.
Exactly, and you're ready.
Yep. Be ready for that.
Dyches, one more comment that I'm sure we'd like to have you just chime in on, and that is that a lot of people have their own aspects about what is the most important thing that they attribute to owning property. Maybe it's management, cash flow, location. We've all heard a lot of those comments. What is it for you? Do you have any one thing that is that you would deem to be critical in terms of owning property?
Well, let me give you actually two. One is that in any kind of investment, you got to have persistence. You got to have staying power. And even when things are going wrong, you got to stick with it and figure out how to make it right. And it's usually right before you're about to get a good return is when things might not be looking so good. The other point is when we're talking about housing, we're talking about any kind of residential real estate, is management. You got to understand management, and you got to be willing to do management. A good manager is worth their weight in gold, and that's really what makes a property produce over the long term. Because if you are good at selecting your tenants, you're good at handling your tenants, and you select tenants that are going to be there 5, 6, 7, 8 years, as opposed to tenants that turn over every 6 months, then you're going to have a whole lot less turnover costs and a whole lot more profit that you can put in your pocket. So I think management is something that a lot of people don't want to do. They look at it as a necessary evil, but it's the one skill that every real estate investor needs to be successful.
Yeah, I totally agree. I think the old adage of only buy properties that you can drive to probably initiated from being able to control desire to be able to control management, and you certainly can have properties elsewhere. And in these days, it makes a lot of sense. But by golly, you better make sure it's well managed. We have on the line with us from Georgia, Dyches Boddiford, who's and also in the studio here, Michael Morrongiello, and they are both longtime investors, experts in notes, and great educators. We'll be back in just a moment on KDOW 1220 AM.
For more information on today's program, visit reradiolive.com. That's reradiolive.com. Welcome back to Real Estate Radio Live, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit reradiolive.com. That's reradiolive.com. Again, your host for today's edition of Real Estate Radio Live, Tom K. Wilson.
Welcome back. We're in luck today. We have not one but two 4-decade investors, Michael Morrongiello and Dyches Boddiford, who are both investors, experts in notes. Michael's here in the studio with me, and Dyches is calling in from Georgia. And they're both great educators. Dyches written many books, and he's going to be out here for in July to teach some classes on IRA. Before we get to that, let's talk a little bit about, from our investment experience, takeaways for our listeners. How important have you seen timing to be, Dyches? You mentioned that you got caught short there in the late 80s when you had a commercial property and got the note called on that one.
Timing can be important, and I'm going to let Michael talk about what he's heard from Bruce Norris, who's another respected investor. But I will tell listeners timing is a difficult thing to hit just right, but you should be paying attention to your market, to what inventory is, and all this information you get from local real estate agents. What the sales are, how fast things are selling, what's the turnover rate, the absorption rate. All these figures can help you get a feeling for what the market is doing. But just like the stock market, it's very hard to call the day that it's the lowest or the day it's the highest. So don't think you can't start investing just because you got to wait for the right time. You got to just understand generally what the best timing would be. But Michael, what does Bruce Norris say about timing?
Well, to him, it's the most important aspect of owning property because in California, we tend to have a lot more cyclical market cycles that values really shoot up over short periods of time and then also can seriously correct. And so I agree that you can't go crazy trying to pick the absolute top or the bottom. But you're right. Look at the market. Look at what's going on right now. Of course, in the Bay Area, some would arguably say that this is a very frothy market right now, and it has been very vibrant. And I think all of us would agree that if you're buying property, especially if you're not buying it long term and it doesn't cash flow, that you don't want to be the one looking for the chair when the music stops and that market starts to seriously correct. So that's kind of what he's espousing is to be very, very careful about the things going on around you, around the marketplace itself, and to be very cautious about the timing of a major investment purchase.
I still had a lot of properties in California around 2000, 2001 when our .com crash happened, and that was cycle number 4 for me to watch. We're watching cycle number 5 here now, but I thought all our cycles before had been 10 years long. And I thought when the .com crash had happened, always when the NASDAQ went down, we had a down cycle, and I was betting that it was going to drop. Well, what I didn't realize was how much the government intervention of subsidized loans and interest rates were going to mask the normal business cycles. So as it was going up in 2002, 3, 4, 5, I thought, this is ridiculous. This thing is going to collapse. And when I met Bruce in 2005, he was the first one I heard who kind of validated my suspicion. And when he said that, and I got to know him and feel confident in his inputs in 06, 7, 8, I sold off most of the rest of my California properties. And, people think, well, geez, that was a lot of luck. Well, there's some luck in it. But, one of my favorite quotes is the great-grandson of the famous Lafitte Rothschild family in Europe, that at one time was the wealthiest family in the world, were asked to what single thing did he attribute his family's great wealth, and he said, by selling too soon. So there's some value and merit in not being too greedy,
right?
And don't have to hit the top and the bottom. Just don't get too greedy, because boy, once you've crossed over that peak, you're chasing a falling knife, right? So,
right.
I think the Rothschilds also said they want to be buying when there's blood in the streets also.
Yeah. Yeah, I think that's pretty good advice. When we come back with Dyches Boddiford, and we're going to talk a little bit about IRAs, which is a subject he's going to cover in depth when he comes out to visit us in the Bay Area here at BAWB in July. And so we'll do that after the break. And also in the studio with us is Michael Morrongiello, and he's also very experienced in that area and can help us ask Dyches some really good questions. So we look forward to being back with you in just a moment on KDOW 1220 AM. Stay with us.
That is a show.
For more information on today's program, visit RERadiolive.com. That's RERadiolive.com. Welcome back to Real Estate Radio Live, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RERadiolive.com. That's RERadiolive.com. Again, your host for today's edition of Real Estate Radio Live, Tom K. Wilson.
Thanks for being with us today. We have in the studio Michael Morrongiello, who's the president of the Bay Area Wealth Builders, also an experienced investor and both in properties and in notes. Also Dyches Boddiford out of Georgia, who's also a 4-decade investor and written many books and is a great educator on topics such as asset protection. We want to cover IRAs in a little bit, but on this segment, can we touch a little bit on asset protection? Dyches, what can you tell us? And got about 3 minutes here in this segment. Give us a little overview of your thoughts on asset protection.
Well, asset protection is a broad subject, and there's simple things that can be done, and let's just hit a few of those that don't even require an attorney or a legal entity or anything, and that is, for instance, keep your mouth shut. You don't need to be bragging, especially to tenants and contractors, about what all that you own. And it's really best to always present yourself as a representative of the owner as opposed to the owner themselves.
I love it. That's, what great advice.
The other thing is you don't need to have showy cars or rings. And the ladies that might be listening to us, your wedding band is enough. Take off your engagement ring and your other jewelry and so forth. That all implies that you might have more than you really do have.
I've always felt that some of the most valuable advice are things that are very simple. I have to insert here that the Conrad Hilton one time, when he built the world's first big international hotel chain, was asked what single thing was the most valuable thing that he'd learned. He said to keep the shower curtain inside the tub.
Makes sense.
Oh, that's great. Tell us more.
Have a P.O. box. Don't have mail coming to your house. I could tell a story, but it'd take more time than we have, of a fellow that sold me a mortgage that he had originated because he had the borrower come to his house at 12 midnight to avoid a $200 late fee. And his wife told him he had to get rid of the mortgage. Well, I made almost $10,000 on that mortgage because he wasn't willing to get a little $65 post office box. So people don't come to your house if they don't have your address. And, they can look it up in Haynes Crisscross and other ways, but have a post office box, because then you can tell them to just go down to the post office and put the money into the post office box by giving the letter to the counter, and they'll hand stamp it that date, and it's okay. It's considered on time if it's stamped that day.
And nowadays you can even have a street address post office box, so it looks like it's a real address, not just.
That's something the post office itself, the U.S. Post Office, started doing about 15 years ago, and always you had private post office boxes that allow you to do that and call it a suite. Mm-hmm. So that's something that listeners should listen to.
Okay. We got 30 seconds for you to give us another couple tidbits here.
All right. The one that's most important is always have insurance. The best attorneys in the United States are hired by the insurance companies. Have good insurance on your properties. That's the first line of defense. The entities and so forth are the backup lines.
Mm-hmm. Yeah, I like to tell people that, keep in mind that for this entity to do you any good, you have to have a problem. After a problem you can't solve, you have to be sued, you have to lose the lawsuit, and it has to be something the insurance company won't cover. Only then does the entity have a shot at doing you any good, right?
Yeah.
That's good. Yeah. We have with us Dyches Boddiford from Georgia calling in today, and Michael Morrongiello, who's here in the studio, both 4-decade investors, very experienced, and teaching us a lot of things from their experience. We're going to come back and talk a little bit more about asset protection, and then we're going to get into IRAs. So stay with us on KDOW 1220 AM, the Wall Street Business Network. We'll be back in just a moment with their special guest for the day.
For more information on today's program, visit RERadiolive.com. That's RERadiolive.com. Welcome back to Real Estate Radio Live, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RERadiolive.com. That's RERadiolive.com. Again, your host for today's edition of Real Estate Radio Live, Tom K. Wilson.
We've got a double header for you today. Michael Morrongiello and Dyches Boddiford, both 4-decade investors on the program, and we're about to talk a little bit about IRAs. Michael, why don't you...
Yeah, Dykes, our good friend Peter Fortunato, who, as you know, is going to be out here next month in July, along with yourself, he has always said that it's more efficient to earn income from investments rather than being being a wage slave or earning it from your employer. And more and more of our income is being taxed. A lot of people are suspecting that taxes may go up or that there's going to be a lot of loopholes that are going to be closed. I know that we have a upcoming educational event in July, and we're going to talk a little bit at the end. But let's talk about why it's so important for people to start taking hold of their own future and being able to generate more and more income from their investments in a fashion where taxes can be deferred or outright eliminated.
Right. Well, IRAs are a great tool to use as a retirement planning structure for you. We're all growing older, and the lifespans are increasing according to the numbers, and Social Security is not meant to be the full monthly amount that you need to live on. You need to have supplement to that. Actually, that should be just a supplement to other things that you have put away for retirement. And by using tax-deferred vehicles, it's the best way to get there the quickest. So the traditional IRA where you get deducted on your tax return, yeah, that works, but you're going to have to pay taxes when you eventually take money out of it. The Roth IRA was a great boon back in the late 90s when it came on board, and now you're able to put up to $5,500 away, and if you're age 50 and older, you can put actually $6,500 away into a Roth IRA. Now, you don't get a deduction immediately, but all the earnings in that IRA over the years are not taxed. So when you start pulling it out after you retire, after 59 and a half, you don't have any taxes, nor do you even have to file a tax return for it. So for those people that say, I'd love to get out of the tax system, this is about the only legal way to get out of the tax system and not even have to file a tax return when you retire if you get your money out of a Roth IRA. But what you will also find is a Roth IRA for some others of us that have a lot of assets outside of pension plans, the Roth IRA becomes a great estate planning tool. Just a $8,000 left to an 8-year-old child upon your passing, earning 8% interest can be over $3 million over that child's lifespan. So it's a tremendous amount of money can be earned over a long period of time with compounding and no taxation.
And Dykes, we obviously in the Bay Area here, we have a lot of not high cost, but high income earners. They've changed, I believe, recently. They used to be that if you made a certain amount of income, you could not have a Roth or you could not contribute to a Roth.
Michael,
that's changed, has it not?
Yeah, those rules are still in place. And a lot of people just look at those rules and say, I can't have a Roth IRA. I make too much money, which, by the way, married filing jointly is around $190,000. So if you make more than that, supposedly you can't have a Roth IRA. But there is a strategy. Congress changed some laws back in 2010 that took the ceiling off converting. So here's how you could do a backdoor Roth. You make a contribution of, let's say, the $5,500 to a traditional IRA and immediately convert it to the Roth IRA. So even if you're making $1 million a year in earned income, you can still, by using that strategy, have a Roth IRA.
So you can convert into it by doing is that a rollover? Is that what that's?
No, it's a conversion.
Just a conversion from a traditional to a Roth.
Conversion from traditional to Roth.
And you mentioned about the child inheriting or taking on the ability to grow that sum of money over a long period of time. One thing that I think about the Roth is maybe our audience doesn't know is that it's also generational as well. It can be rolled. I think you use the term stretch IRA.
Yeah. Once someone inherits your IRA when you pass on, they can name someone that would then inherit that IRA after they pass on if all the money hadn't been distributed out during that time. And we actually have an example in the class of a 150-year stretch.
Wow, that's phenomenal. And I know we all are different. We all make different investment decisions. But what are some of the things that this audience might have look at in terms of making as investments in their IRA?
You could actually buy rental property in the IRA if you desire to. Now, there's some rules that go along with that, and if there's any kind of lending, any debt on the property, there is an auxiliary tax called the unrelated business income tax that has to be paid. But if the IRA was able to buy it for all cash, then it would be tax deferred or tax free in the case of a Roth. But, Michael, you and I like to use our IRAs to do notes that are secured by real estate. And by far, I think that's the better advantage with the Roth IRA is making loans and buying discounted notes.
Yeah, I think that's tremendous because, as you and I both know, and for our audience, that interest income is highly taxable. It's a portfolio-type income,
right.
And having those investments in a vehicle like a Roth or a traditional, you avoid a lot of that.
And you gain a lot more interest than you get in a most bank or any kind of guaranteed savings accounts. We're looking at returns anywhere from a loan that you might make of 8% up to 20 to 22% if you buy partial discounted mortgages.
Mm-hmm. Yeah, those are phenomenal opportunities.
Right. So we'll be talking about those at the education event you were referring to a little bit earlier, and actually giving you examples of deals that we've done, both with the houses and with the notes and mortgages.
Okay. When we come back after this break, we'll tell you how you can take advantage of that and some of the education resources that are available to you. So we have Dyches Boddiford calling in from Georgia, and we have Michael Morrongiello, who's here in the studio with us from Bay Area Wealth Builders. We'll be back in just a moment and tell you about upcoming programs and how you can learn more about these topics.
For more information on today's program, visit RERadiolive.com. That's RERadiolive.com. Welcome back to Real Estate Radio Live, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RERadiolive.com. That's RERadiolive.com. Again, your host for today's edition of Real Estate Radio Live, Tom K. Wilson.
Boy, time goes fast when you got a couple of experts on the program. There's a lot more we'd like to cover, but Dyches, can you just give us a little wrap-up of some of the key takeaways that we've talked about?
Well, Tom, we talked about getting started, and I talked about just getting out there and doing it, persistence, sticking with it. We talked a little bit about the timing of buying and the timing of selling, which is just paying attention to the market and getting a feel for what's going on. We also talked about making mistakes by putting too many eggs in one basket. You need to diversify over several investments. And we talked about some asset protection, some simple tools, keeping your mouth shut, having a P.O. box, not bragging about what you've got. And all of that leads us up to, all right, now how do we become efficient investors? And one of the best things is to remember that we are going to pay at least a third of all the income we ever make to the government, to the IRS, and we need to get that partner out of our back pocket. And one of the ways to do that and to secure our retirement is to use the IRA, particularly the Roth IRA. And we talked about how high income earners can still have a Roth IRA by using the backdoor method of contributing to the Roth. But the key to these IRAs is not how much you put into them, but how much you can make them grow. And that's what we're going to talk about in July at the weekend class. Michael, do you want to talk about that?
Yeah, this is a class, Dyches and Tom, of course, that's going to offer something for everybody. The last time I know that we had this class in the Bay Area was 6 years ago. It is going to be coming up on Saturday and Sunday, July 18th, July 19th in South San Francisco. We'd love to have people get more information. If they want to get a brochure, if they want to register, I encourage them to go to our website, which is www.bawb.info, and then click on the workshops link. Again, that's www.bawb.info, and then look for workshops. As you've mentioned, and I think Tom and I both agree, this is a very, very powerful topic. You need to take more and more control of your own future, and do not rely on the government. You need to take care of you, and this is really very, very powerful for folks to seek out more information. We hope to see you in July.
Yeah, indeed. And if you happen to be listening to this podcast after these times, don't hesitate to go back on BAWB to see what other things are coming up, and also to TomWilsonProperties.com. We can get you connected up with Dyches and Michael. And again, sign up for our newsletter on TomWilsonProperties.com. We've got some white papers. We provide high-quality rental homes and commercial syndications for investors. So, go check out these resources. All of these websites have a lot of resources. And Dyches has a number of books that he's written. You got another item?
I was going to recommend that people are coming to this class are often even bringing their own tax advisors as well as legal advisors too. It's that powerful for folks. Good,
great. That'd be nice to have you folks be there. I'm going to be. Thanks for being with us today on KDOW 1220 AM, the Real Estate Radio Live program. Come back with us next week. And remember, the only thing that matters is what you do next.
You've been listening to Real Estate Radio Live. For more information on today's program, visit RERadiolive.com. That's RERadiolive.com. Tune in, log in, download our podcast. Discover more at RERadiolive.com. RERadiolive.com.